Let's start with the local market, and it was a strong finish to the year last year for the ASX 200 despite very low volumes of trading activity. It was a year characterised by a lot of large mergers and acquisitions, some a little bit controversial. We're now looking at a very consolidated market. Will that trend continue into the new year? Steph Nash investigates.
Well, I think it's that overused term. It's challenging. It certainly was challenging times over the last 12 months. It's been challenging for the last couple of years.
Hit by the aftermath of the pandemic, rising interest rates, increased geopolitical volatility, war. It's no surprise that the Australian share market received a mixed report card in 2023. The late Santa rally and a slew of last-minute deals catapulted the ASX 200 back into bullish territory, but trading activity overall saw a very weak year.
And that was a lot of worry for investors, so the trading volume was very, very weak. Throughout the year, even though we have a bit more clarity about where things are going, but we then throwing the mix was there's a geopolitical uncertainty, there was war, there was oil prices, volatility, all of that into the mix. Then again, investors were sitting back thinking, perhaps we should sit back with the defensive companies, with the company that paid dividend, and to see how we go, see how it pans out. We don't need to be fully invested.
According to the market statistics from the ASX, trading activity was down 20% over the calendar year. Total new listings more than halved, and total capital raised was down around 60%.
It's not the sort of environment that people want to do a lot of trading in, and there's not a lot of visibility. You think just as I'm about to take on a position, something will come through from left field, and invariably it has over the last 12 months. With interest rates, do they continue to rise, or do they pause? And we saw the pause in interest rates. Then we saw the situation late last year with the Middle East, and now we've got the ongoing instability in that area affecting things like shipping. So I think it's the fact that it's hard to be a trader in this sort of environment.
Towards the end of the year, we saw a bit of rally. After the October sort of dip, November and December, we've seen investors really decisively trying to come back and pick up some risk, but still below what it was in the previous years. But we are seeing by November and December, investors trying to put some cash back into the market. Hence, saw our market actually had some of the strongest rally in December, and the December quarter was the best performing in the world in that December quarter, and taking the full year to be above everyone else within the Asia-Pac region.
If there's one word to describe the market activity of the previous year, it's consolidation. Lots of big deals. Lots of takeovers.
By the end of or mid to end last year, we started seeing a lot of sort of investors' risk appetite returning. They feel a little bit more confident about the future. In particular, actually the most important point is that they have clarity of where interest rate might go to. So with that kind of certainty, a lot of companies can then go out and get debt with confidence where the interest rate might be. And outlook for the interest rate, if anything, is falling. So suddenly the debt becomes cheaper for them to go and buy assets. And at the same time, the Australian listed companies, many sectors were trading at very depressed valuation. So that's why we're seeing a lot of increasing merger and acquisition activity that is coming through, trying to take advantage of stabilization in the debt market and cheap valuation for the asset they want to buy.
Well, I think it's hard to go down the track of organic growth, and for a number of companies, a number of sectors, it's probably easier to get together with another firm in your sector and to be able to embrace the opportunities that exist. So we're seeing that, sort of in terms of the energy sector. We're seeing it, some lithium and gold, and I think that's going to continue over the next 12 months, because there are great opportunities for bigger companies to be able to embrace the opportunities that lie there, the productivity, the efficiencies, and the opportunities in terms of further growth as well.
Merger activity was particularly strong in the latter half of the year. $5 billion in deals on a single day, 1 week out from Christmas. Perhaps a sign of investor attitudes changing and volumes on the rise.
And I think in the March quarter, this quarter we're in, we are going to see significant amount of activity. This is simply because it's the same thing. We are seeing the peaking of interest rate and the expectation of fall of the rates now. So forward-looking rates are now started falling. So that is very good for the debt environment. And two is that there's a lot of asset trading on very steep discount. No one wants to touch because we don't know where economic activity might land. But now we have a slight more certainty about a slowdown and soft landing. We expect that to pick up massively, and if anything, this next couple of months is going to be significant.
I think as the year goes on, we will get sort of a bit more visibility in terms of the macroeconomic landscape. I think what we will see is a number of central banks basically are on hold, and then we'll move into an easing cycle. It may not happen until the mid part of the year or the second half of the year, but we're at that process now where things are starting to change again. Interest rates are no longer going up month after month. Things are settling down, and that will provide sort of traders and more longer-term investors with a greater confidence to come back into the market.
Perhaps also a continuation of the active investor approach of our super funds.
Absolutely. I think, super fund will be, they're already holding a large part of Australian market. In the next decade, I think they will become a, huge, owner of the Australian market. It's simply because they have a lot of natural flow from people's super, and it continues to grow. So you will continue to see more and more, high quality company to get bid for by those super funds, and companies whose valuation is disjointed or too cheap to be what it is, rather than a private equity, it will be super fund taking them private because they invest for the long term and they can see the value in holding a lot of those assets and get dividend in between.
Looking at the best performing sectors, the tech sector was the leader, up around 30% over the year, while on the bottom was the energy sector. With reporting season rapidly approaching, it won't be long before we start to see some of the early winners and losers of 2024.
Now, I think tech company will continue to be that core holding in the portfolio, but the valuation expansion, which took place last year, is pretty much done. It's harder to see them double from here, given how expensive they are already looking relative to every other sector. I think this year, consumer sector might do okay, particularly as we start the year. We're seeing the actual trading condition for those companies on the ground is actually not too bad. The likes, particularly some of those furniture, consumer electronics, will do quite well. We've got tax cut coming through mid-year. We've got economy actually looking pretty good towards the back part of this year. So we think the consumer sector will do well.
In the first half of this year, as things start to settle down and we start to see inflation comes down and talk about interest rates cuts come through, is that there's going to be an embrace of quality, getting quality companies out of a whole range of different sectors. So it's not just a case of picking the tech sector or picking the healthcare sector. It's a case of picking quality companies out of those sectors to be able to take you forward. Now, when you move into the second half of this year, and with interest rates then starting to fall, then you may start to embrace the more growth opportunities in the market, the materials sector, to real estate, and IT again, in the second half of the year. But I don't think, in the first half of the year, we're going to see a sectoral movement. I think it's going to be a movement to quality companies rather than to sectors.